Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner and adjunct assistant professor at Purdue University. Consider This is brought to you by the Financial Enhancement Group, LLC, where Joe serves as managing partner. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Anderson, with offices in Anderson, Lafayette, Indianapolis, and Rensselaer, Indiana. This show is for educational purposes, and you're strongly encouraged to consult with your financial professionals for personalized guidance. Big Joe can be reached at 800-928-4001. You can find out more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Hello and welcome to Consider This. Joe Clark, Sherry Contos, and others. You are listening to the best of Consider This put together over the last few years of this show. You can find the information from the show on our website at yourlifeafterwork.com, iTunes, and various other places. Obviously, we're here weekly on WILO from 4 to 5 p.m. During drive time. Saturday morning on our flagship station of WQME from 9 to 10 a.m., and Sunday mornings on Shine 99 between 10 and 11 a.m. Consider This really is a show that's much more than just the weekly headlines. We work together to try to give you insights and directions into things that you may want to consider about your financial lives. And the questions come in many directions. You can always reach us on Twitter, hashtag AskBigJoe. And of course, you can email us your questions. Consider This, that's all one word, consider this at yourlifeafterwork.com. We break the show down into what we call 5 critical financial elements. One, always begin with the end in mind, so we start with retirement income. Where is the money going to come from to maintain your standard of living? Number 2, then, is the tax plan that needs to be done each and every year before the end of the year. 3 is the investment policy statement. What's going to keep you from getting caught in a downturned market without paying attention, without having discipline to how you want to respond? 4th is life happens. It's the good and bad and ugly of life, the things that we just normally see that take place. Last but not least is the legacy plan. Everything that we do is all about your life after work. That's the name of our website, yourlifeafterwork.com. We want to take what's going on in the world, keep you abreast of changes that matter. Sure, it's always fun to talk about markets and headlines, but what we really want to do is give you things to consider. So as I said, shoot us an email, consider this at yourlifeafterwork.com. Enjoy the show and keep in touch. We'll be right back.
Consider This with Big Joe Clark is brought to you by the Financial Enhancement Group, a Hoosier-based registered investment advisory with more than $150 million under management. The Financial Enhancement Group serves clients in 25 states and proudly takes care of people who don't want to worry about their own money. You can find out more about the Financial Enhancement Group at yourlifeafterwork.com or reach any one of our 4 Central Indiana offices at 1-800-928-4001. Your Life After Work. That's what it's all about.
Well, good morning and welcome back to Consider This, or as Sherry said, good day, we should say.
I think that works for everybody.
It's
good
the
day.
afternoon, could be the morning, regardless.
Yes.
Hopefully we're giving you financial insights that will work for you regardless of
That
when you're
would
listening.
make it a good day.
That would make it. Ooh,
See, there you go.
I like it,
There
Sherry.
you
I
go.
like it. Hey, I'm Joe Clark.
Sherry Contos.
Happy to have you along. A week or so ago on the show, I mentioned a book called Outliers by Malcolm Gladwell, and I'm blessed to be able to read and to be able to be around, I guess, some of the greater authors and people who give great speeches. I think Malcolm does a great job talking. He kind of looks a little bit like Einstein.
Really?
He wrote a book called Tipping Point. Wrote another book called Blink, What the Dog Saw. And my favorite by far is Outliers, and it's a really good book.
One word, 2 words, outliers.
One word.
Like it's a description of people?
No. So statistically,
Okay.
when you hear people talk about standard deviation and all of those things,
Yeah.
something that is more than 3 deviations away, 3 standards away, is considered an outlier, or some people would call it a fat tail.
Okay.
But what he's looking for in that book are things that are just they're abnormal, easy for me to say,
Yeah.
abnormal events that are outside of what you would expect in a normal period, or in a normal study, or sample. So one of the things, for instance, is the people who play in the NHL, the National Hockey League.
Okay.
It's like over 70% of them are born in one of 3 months.
Really? And all in Canada, right?
No, but a lot of.
Yeah.
But when you look at that, I mean, that is clearly an outlier. So what caused it?
Yeah.
And so anyhow, one of the things that he talked about is that in order to be good at your craft, you have to do 10,000 hours. And we've got these really smart people at AU, Anderson University. And so one of them decided to do a little bit of studying. Turns out there is a very interesting infographic that talks about how long it takes to become very good at something. And I love infographics. If you've not seen one, they're a picture that tells a story. And they usually have a little bit of text, but they're laid out nicely. If you would like this one, email me, considerthis@yourlifeafterwork.com. We're happy to share the email with you, or the infographic with you. I may or may not get it put up on the website. Can't promise. That's not my end of the deal. But we do have the infographic, and it's cool. So here's what we found out, Sherry.
Okay.
It takes 320 hours.
Yes.
To be a celebrity gossip column writer person.
Oh, really?
Yeah, 320 hours.
Does that shock you? It does not shock me at all.
It shocks me.
It shocks me that it takes that long.
And actually, I think it's wrong. It takes longer than that to be able to write and to be a columnist. To know about celebrity gossip would take me about 3 minutes because I just don't care.
I'm in the same.
That would be gone. That would be gone quickly. But what was interesting is to be an expert. According to Gladwell, in playing piano or darts or golf, it takes 10,000 hours. What Logan was able to find on the infographic was to be an expert in economics.
Yes, let's talk about that.
It was a little over 23,000
because
hours.
Everyone knows people who study economics are just naturally smarter and have to, there's more to it, and we really can apply it to more things.
Yeah, that's because you have a degree in economics.
I know.
That's where that's coming from.
Well, okay, go ahead. Oh, dear.
Oh, so it's nice to see that they recognize economics takes 23,000 hours.
Yes.
But here's where I would challenge that.
Of course. What?
Well, of course I would.
Yeah.
I started in this industry 2 weeks before the crash in '87. And a lot of you
perfect timing.
It was great. I had no clients. I had no money. It was beautiful.
It was beautiful,
right?
Yeah.
I got to see how other people behaved. But my point being is from 1987 to now, I've got a lot more than the 23,000 hours put in.
Yes.
But to think that the world was the same in 1987 as it is today is not true, right? So when you think about John Wooden and the foundation of basketball, right? Wooden taught us some things. He would spend, allegedly, I obviously wasn't there, but he would spend the first practice on teaching the boys in college how to put on socks.
Really?
And think about that. And that was the old story, because you get a blister, you can't play, right? And so he would teach them the fundamentals from the bottom up. The fundamentals of economics probably don't change, but there are so many forces that do. We live in an entirely different world. So I am very thankful and fortunate that I've been able to be in this industry and have this career. I'm very blessed to be able to teach it at Purdue and to also be a managing partner of a firm. It's been an outstanding life, and I'm just very, very thankful for that part. But for me to tell somebody that it's the same now as it was when I started, it's really not accurate. So let's do a little John Wooden, and let's talk about some fundamentals, shall we?
I think we should.
Okay. So there's this big word that bothers some people because it's not one you would use in a normal vocabulary, but it's called fiduciary.
Yes.
And
we talk about it all the time.
It's because it's important to us. Yeah. And so what fiduciary essentially means, is in as simple English terms as I can put it, is that I have to, as a legal fiduciary, take care of your money as if it were my money and I were in the same situation as you are. So when Sherry says, Joe, here's my stuff, right? Here's my tax return. Here's my investment statements. Here's my retirement plan from work. Here's my Social Security information. Here's my estate plan. I have to look at it as a certified financial planner, 27 years of being in the industry, from everything that I know from Purdue, from being an adjunct assistant professor there for the last 7 years, I've got to take all of that and I've got to act on your behalf exactly like I would if I were in the same situation. And that means that I'm not trying to sell you something under suitability.
Right.
And that in my mind, that does not mean that people who sell things, mutual funds or that work on commission, it doesn't mean that they're not necessarily acting in your best interest, but there may very well be a conflict.
Right.
Right.
And
so
it'd be hard to see through that, though.
It really is. So as a fiduciary, right? As a fiduciary,
yeah.
I have to treat your money as if it were mine in the same situation. So what I need you in Radioland to recognize is that we all have a fiduciary. Everybody does.
Yes.
Either it's you, or you've hired somebody that is a licensed legal fiduciary, registered investment advisor, to do that. That's not a stockbroker.
Right.
It's not somebody that works at one of the national firms that's driving down the road. Either you are the fiduciary or you've hired somebody to do that. So when you go to the doctor and the doctor says, what's wrong, Sherry, and you tell him what's going on, the doctor doesn't look at you and go, well, here's 3 prescriptions. Which would you prefer?
Right.
The doctor says, this is the prescription you're taking. That's really the difference. If I was in the business of selling things, you would come to me.
Right.
I would lay out 3 things that I said, these are all pretty good ideas, but at the end of the day, you have to pick. You've got to make the selection. Under a fiduciary, I pick. I'm the one that ends up making the decision. You either decide to hire me or not hire me, but I'm not going to call you and ask you what you think about an earnings report,
right,
or what you think about what's going on economically
because that's what we're
in
paying
Greece.
you for.
That's what you're paying us for, right?
Yeah.
So let's assume for a second that you're your fiduciary.
Okay.
We're going to go back to the John Wooden, the fundamentals. Mm-hmm. There are 4 areas that you have to have a very good grasp of.
Okay.
And what I call them is the fiduciary focus. Mm-hmm. And I love filters. We've talked about Malcolm Gladwell and Outliers. The Checklist Manifesto is another one of my favorite books. But you've got to have this filter system of how you think about things, and you can't let one thing necessarily dominate another. So those 4 areas, the first one is risk and volatility, and that's the market moving. Where does risk come from? What does it mean? How does it relate to what's going on inside of my retirement or my portfolio?
No, is it risk as in the reality of risk in your portfolio, or is it risk as in how much I personally can tolerate?
It's both.
Both. Okay.
But remember, when you hear the word risk in our industry, it essentially means getting something different than what you expect.
Ah.
Right. So, go back to FDR. Right. And history is important.
Sure.
You go back to the fireside chats. Roosevelt needed money back in the banks. Mm-hmm. And whether it was him or one of his speechwriters, I can't tell you. But that was the first time you ever heard the stock market referred to as risky. Because he knew, as a human, when Sherry hears the word risk,
I'm going to think
she
twice.
thinks loss of principal.
Right, yeah.
Right? Risk really means getting something different than you expect.
Could be good or bad.
The stock market is speculative.
Right.
Because it can be up or down.
Right.
It's not risky in the way that our minds process risk. It's speculative, right?
Right.
But understanding that risk and volatility, knowing where you are in your life, whether it's retirement time, whether you're young, how soon it is till you need to be able to access some of that money, being able to acknowledge that and put together the right plan, that's the first thing. And sadly, it's what a lot of people get fixed on. They spend their whole lives mesmerized by the risk and the volatility. They either are totally immune to it and have it all in equities, or they're scared to death of it and have it all in cash,
right,
and hide it in a mattress if they could. The second one are fees and expenses. And as we've talked about on the show before, those are different things. Fees are documented. You know what they are going in. Expenses are the part of doing business along the way. And we're going to spend a little bit of time on that in the next in the next part of the show. But you want to make sure that you're paying an appropriate amount. That doesn't mean free. That doesn't mean, you want to pay an appropriate amount of fees and expenses to be able to get the job done that you want done. The third one is the taxes, but both today and tomorrow. If you're used to going to our website at yourlifeafterwork.com, you can go to last week's show, and I spent time teaching you how to read your return. We broke down the return, the things that you needed to know to really be aware of, and what was going on. Last but not least is making sure that you get a real return. Now, real is when you add inflation to it. So if it costs 2% more to buy stuff this year than it did last year, then a real return is something that's positive plus 2%, right? That's what real means. And it's important to pay attention to it. It's one of the biggest mistakes that I see people make in retirement planning, Sherry, is they look at their income and they say, well, I need $4,000 a month.
They just look at the dollar, yeah.
I need $4,000 a month. They don't understand their life expectancy. If a husband and wife make it to age 60 in reasonable health, not great, in reasonable health, the actuaries tell us that there's a 90% chance one of them lives to be 90. So that's 30 years, folks, that you've got to be able to have an income stream that continues to grow. And it is important to understand that impact of inflation, what it can really, really do to a portfolio and so forth. So if you got a question or comment, you can shoot us an email. Consider this at yourlifeafterwork.com.
Or tweet us.
Yes,
at hashtag AskBigJoe.
That's how you get a question directly to me.
Yeah.
If you want to follow us on Twitter, it's big_Joe_Clark. So, I don't get it. And if you want me to send it to you, just like I said, shoot us an email. Consider this at yourlifeafterwork.com. I got to take a break. We will be right back. We're going to talk a little bit about those fees and expenses and a little bit about history.
Ooh.
Take a break. We'll be right back.
Are you overwhelmed with financial complexity? Are you confused about how your 401k and your IRAs work together? If so, you're not alone. At the Financial Enhancement Group, we work to make your financial life simple. On a single sheet of paper we call the Family Focus page, we help you lay out your long-term financial objective with the next 36-month key financial objectives. At the Financial Enhancement Group, we keep it simple. We keep you on track. We work together. 800-928-4001. We look forward to hearing from you.
Well, good morning and welcome back to Consider This. I'm Joe Clark.
I'm Sherry Contos.
And who are you? No. Seriously, let us know. Shoot us an email. Consider this at yourlifeafterwork.com.
That would be fun, actually, to know who's...
As they say, keep the conversation going. You find it interesting when people tell you that they've heard you.
I really do. And it's like funny because in this particular case, I was coming out of a dressing room. I had a whole pile of bathing suits in my hand. So it wasn't the time I wanted to be caught by people, saying, oh, I heard you on the radio. But anyway, it was fun.
It works out very, very, very well. So... Yeah. I want to take you back into time because fees and expenses seem to really confuse people. So in the probably 95, 96 era, back in that period of time before the tech wreck, all of a sudden you started to find these online places where you could go and do stock trades. And at that point in time in my career, if I made a stock trade for you, it was anywhere between $210 and $300 to buy or sell a stock, right? And that could be to buy, and those are our cost, right? And that could have been to buy or sell $1,000 worth of stock, or $100,000 worth of stock, or $1 million worth of stock, right? And brokers would have a minimum that they would be able to trade. And then they would charge you a kind of a percentage, if you were going to buy or sell those stocks. And so a lot of people started using mutual funds because inside of the mutual fund, you were with a bunch of other people and it would reduce that cost of the trading. All right? So because now we're buying or selling a bunch of stock. Well, an interesting thing happened on the way to the grocery. People forget that's why mutual funds gained so much in popularity, was to reduce the fees and expenses. So going back to the late 90s again, all of a sudden you have these companies that come out like E-Trade, that would trade stocks much, much cheaper than what you could at a Merrill Lynch or, at a Raymond James or any of the places. Much, much cheaper. And the word, Wall Street's going to go under. People sold the Wall Street stocks. They're not going to make any money. And I'm sitting back giggling because people really didn't understand how Wall Street made its money. You know, in the movie Jerry Maguire, you know, the guy said, "Show me the money." Right?
Yep.
If you're going to be your own fiduciary, if you're going to manage money, you've really got to know where the profitability comes from. And so, when I buy or sell a stock, I have to do it on an exchange of someplace, either the New York Stock Exchange or the NASDAQ. But Sherry, there is a bid price. That is what they will essentially buy it for. And there is an ask price. And that's what they'll sell it for, right?
Okay.
So you've got a bid price, you've got an ask price. There's a space between the two, and that's called the spread.
Right.
Right? So those of us that have a little bit of gray hair somewhere will remember that stocks used to trade in the eighths. So people would say it was 12 and 7/8, right? Well, each eighth was 12 and a half pennies. There's 12 and a half cents in eight 12 and a half cents to make up $1, right?
Right.
So it would be 7 and an eighth, meaning 12 and a half cents. Well, the space, the bid and the ask was always at least an eighth off, right?
Okay.
So Wall Street didn't make their money on the transaction.
Mm-hmm.
Wall Street makes its money on the spread. Mm-hmm. If you're buying and I'm selling, that was at least an eighth each way, right?
Sure, yeah.
So when you look at Wall Street and you realize that in a normal market on one exchange today, we trade more than 1 billion shares, and we're talking about a day, right? Think about 1 billion eighths two ways. Because I bought it and somebody else had to sell it.
Yeah,
right?
yeah.
So we're talking about a quarter each time something happened. Now, today we trade in pennies. It's not eighths. And the spread between them may not be 12 and a half cents, but the volume, the number of shares that they trade is much, much greater, you know, than what is going on. Wall Street made its money that way. Now, why did I take you back through this history lesson? And the answer is a large conversation that's coming out of the Department of Labor, the Securities and Exchange Commission, the White House. There is this conversation in 401k plans of whether or not the person who is helping you with your 401k needs to be somebody like we are at the Financial Enhancement Group, a legal fiduciary, where I am liable to treat your money as if it were my money, not in the same situation, not where there's fees, not where it's just fees and expenses. Well, the hilarious part of this conversation is everybody is focusing on the fees, not the expenses.
Huh.
Right? They're focusing on what is documented, the money for the TPA, the third party administrator to file the tax forms. They're focusing on
the bill you get. You can see that number.
You see, right? Mm-hmm. Without understanding the true nature of where the expenses really come from.
Yeah.
People buy mutual funds because they don't understand all of the expenses that exist inside of them. So I'll give you for instance.
Okay.
There is a great mutual fund manager. He does a phenomenal job at one of the big 401k places. He has a fund that has $118 billion in it because he's done a great job.
Okay.
Right? His fee, Morningstar, tells everybody that he is a very cheap fund, because he only charges 65 basis points, that means 0.65%, to manage the money, right? Well, but he's 0.65 on $118 billion. It's hard to even get that out. $1 billion, a lot of money.
Right.
The turnover ratio in the fund is about 45%.
That's a lot, isn't it?
That's a lot. But Morningstar says it's a good job because of the way they track turnover.
Okay.
Right? There are 307 holdings inside of the fund.
Okay.
Right? 307. The 10 largest holdings, of which, by the way, Google has Class A shares and Class B shares.
Okay.
2 of the top 10 are both Google.
Okay.
And they account for 26% of the $118 billion.
Wow.
So here's your trivia question, because you got to put all this together. A lot of my world is connecting Poké dots, right? You got to put all this together, understand why I talked about the mutual fund before, right? So now you've got $118 billion. You go online, it tells you it's got a 45% turnover ratio. What does that mean?
Buying and selling.
That's turnover.
That's turnover. But it doesn't tell you if it's turnover of like mutual stock or individual stock, right?
No, it's what people perceive it to be.
Okay.
And in fact, even if you go to Morningstar and you look at the definition, I think it's amazingly confusing. The definition appears that means that 45% of the 307 holdings are sold on an average annual basis over the last 2 years.
Okay.
That is not what turnover ratio means.
I think it's individual.
Turnover ratio, the 45% turnover ratio is of the 118 billion.
Right.
So you get the 307 holdings. The 10 largest are 26% of it.
Right.
Now we're talking about the other 74% being bought and sold throughout the course of the year, which, number one, if it's not in an IRA or 401k, creates a huge amount of tax liability and problems. But it's also how they get paid. Not the manager, but now we went from the fee, that's the 65 basis points.
Right, yeah.
Now it's the expense. So when you're a large mutual fund family that controls trades on the exchange where you're making the bid and ask price, right? That spread is like a huge casino for you. And the more shares that are bought or sold, the more profitable you are. And so if you happen to work at one of these, or if you happen to have your money at one of these companies that is on the exchange, and you know who they are, think about the places in Indianapolis that have the offices, you know.
Yeah.
Then the more activity there is, the more money that place makes. So this argument over whether people are managing should be a fiduciary to be in a 401k is a very, very important part. Fees and expenses are critical, but you can't just focus on the fee, guys. You have to understand how this game is really played. Wall Street didn't go under when stock trades became $7 a trade, because that's not how they got paid. It was tertiary. It was a lot of money, but it was a whole nother part of the deal. When you're looking at the fees inside of a 401k plan, that is entirely different than the expenses. And until I can help you pull the covers back so that you can see what's really going on inside of your retirement accounts to understand how that money is working, then you need a fiduciary, somebody who's there looking out for you to try to keep those fees and expenses controlled. Remember, there are four things: the risk and volatility, the fees and expenses, the taxes both today and tomorrow, and last but not least is making sure that you get a real return. It all matters greatly. Hey, you're listening to Consider This with Joe Clark, Sherry Contos. We are happy to have you along. You got a question or comment, shoot us an email, considerthis@yourlifeafterwork.com. We do our best to make retirement simple. I try to keep it simple here, but I want you to be more aware of the things that you just may not know. Got to take a break. We'll be right back.
Consider This with Big Joe Clark is brought to you by the Financial Enhancement Group, a Hoosier-based registered investment advisory with more than $150 million under management. The Financial Enhancement Group serves clients in 25 states and proudly takes care of people who don't want to worry about their own money. You can find out more about the Financial Enhancement Group at yourlifeafterwork.com or reach any one of our 4 Central Indiana offices at 1-800-928-4001. Your Life After Work. That's what it's all about.
Well, good morning and welcome back to Consider This. Joe Clark, Sherry Contos, happy to have you along. If you're wondering why I said good morning, we run this show throughout the course of the week. Our flagship station's WQME. It's Saturday morning, 9 to 10. Happy to have you along. Sunday mornings on Shine 99, 10 to 11 a.m. And then, of course, our new station, WILO, Thursday afternoon, 4 to 5 p.m. drive time. Please drive safely. Happy to have you folks along as well. You're listening to Consider This. I do my best to try to give you things to consider. talking about the financial world and things that are going on. Sherry, of course, is the one that keeps me straight and in line and makes sure that it comes out in terms of English. So, Sherry, you had a point or an observation about the market carver.
I did, actually, because I just started getting that, and people can do that by going online on our website and look under a market carver newsletter. But once you do that, once a week, you'll get this kind of like, I'm going to call it a progress report about the market. It seems like it's kind of the current, what's going on. And this week's was really interesting to me because of, I like visual things. Mm-hmm. You have a cool chart on there. And it's one of those charts that the things in investments that are working are above the line and the things that aren't below the line. And I've thought it was really interesting. Commodities way below the line, and it says it has been for a long time. Yeah. And
about 3 years. So we do two market carvers. There's, we manage money for people. A little over 500 families that we serve, and I've got an allocation team with a chartered financial analyst and a chartered market technician that are part of our team that are in-house, part of the Financial Enhancement Group. So we manage money for families we serve, and I send them a detailed market carver every week. We also do one for the public. That's, you're free to get. Like Sherry said, go to yourlifeafterwork.com. You can get signed up for it. And I just try to bring big, broad points that if you're going to take care of your own money, there are things that you should probably consider. What I want my families that we take care of to know about, obviously, is a little more in detail. But what Sherry's talking about is the chart that says, hey, here's what's happening year to date. And this is why it was so critical, Sherry. You found commodities interesting.
Yeah.
What's interesting is that notion of diversification that we talk about, Grandma said not to put all of your eggs in one basket. But what does that mean? What do you do with that? And so, most people have money in maybe the S&P 500, maybe a little bit in the international world, maybe a little bit in bonds. Some people have money that's all over the world. America's a small part of 23% of the world GDP, so it should only be 23%. Different people have different attitudes. Here's what we know: the last couple of years, the worldwide story has all been about the United States S&P 500. That's where all the performance has been. And, people are, I'm getting emails and questions. Joe, what about the Dow? Apple just got added to the Dow. AT&T got the boot. What does that mean exactly? Is Apple going to go up now? Well, Apple's on a tear. It's been going up.
Yeah.
Is AT&T going to go down? The Dow is an index. It's price weighted, which means it's based on the price of the stock, whereas the S&P 500 is market capital weighted. The larger the market cap, the better you're going to be. And typically, because the S&P 500 is the most tracked index in the entire world, when something is added or taken out of the S&P 500, big changes happen. Not so much necessarily inside of the Dow. But you're right. The commodities have been off for about 3 years. And if Andrew was in here, Andrew Thrasher is our chartered market technician, he would be mad if I tried to come up with a reason.
Oh, would he? Why?
Because he's our technical guy. His job is to pay attention to money flow.
Oh, I see.
Price action tells everything at the end of the day. At the end of the day, the market's going to be up or down.
Yeah.
My job as a macroeconomist, as I take care of what we call the narrative leg of the story. My job is to take what happened today and say, well, it was probably because of the unemployment numbers dropping largely last week and the Federal Reserve's issue over interest rates. I'm going to come up with the story things. Mm-hmm. But at the end of the day, we don't know that's what happened, right? All we know is that prices were higher or lower.
Okay.
And so technical investing does matter. I'm not talking about technology companies. Technical investing, that's Andrew's job. Adam's job is going to look at the companies that we own and want to make sure that they are fundamentally sound. That the percentages that we have are fundamentally justified. And then my job is that it fits in the overall story in the macroeconomy. The three of us come together in proprietary process, and we build portfolios out of that.
Figure it out.
Well, so why I showed that on the market carver last week is if you've listened to the show for a couple of years, I've told you that being in the international world was just painful. Grandma said not to put all of your eggs in one basket, but that doesn't mean we want to buy rotten eggs just so we have...
Just because.
We don't need purple eggs if we don't need purple eggs. And the international markets have just been thrashed the last couple years, especially relative to the S&P 500 in the United States domestic market. Mm-hmm. And so we kind of looked at it from the standpoint of things are changing. The international world the EFA and the emerging markets, both up. One up 7% at the time of that video going out, versus an S&P 500 that was up about 2.5% at the time. And so you need to be aware of those relative changes. So if you can reduce risk, Sherry, and by reducing risk, I mean adding more diversification and have the ability to maintain or increase return, then it's something that you at least need to consider if it makes sense in your portfolio.
But okay, so you said to pay attention, see what's going on, but what would someone do if they're trying to manage their own money and they see all this happening?
Well,
what would they do?
The challenge is most people who are managing their money don't see it happening, because there are things that happen under the radar. A couple weeks ago in the Market Carver, we talked about the difference between 2000, the tech wreck, and now. And remember, we talked about the price-earnings ratio of what we call the five horsemen.
Right, yeah.
You know, Microsoft, Cisco, Dell, Intel, and MCI back in 2000.
Right.
You know, today the S&P 500 has a higher price-earnings ratio, which in theory makes it a little bit more aggressive, a little more risky, if you will. But the big companies that are driving it actually have relatively modest price-earnings ratios, especially compared to back in 2000. So it's not necessarily you need to do this, you need to do that. I can't do that for you.
Yeah.
Right? I do it for the families that we serve.
I know.
But what I want to give you is good content that you really need to consider, to think about, and to understand how things really work together. Right? And that's important.
That's a hard thing for an individual to do, though, I think.
So I'm a zoo guy, right? The Indianapolis Zoo, largest zoo in the country that's privately supported. We get no tax dollars from Indianapolis, none from the feds, none from the state. I like it that way, right? So I will put my money where I think it's best served, and I think they do a good job.
Yeah.
So one of the we have this great cheetah project down and at the zoo, and if you've not been there, you need to go see the cheetahs. It's an incredible exhibit. They do a great job, and so backstage, we're working with the cheetah people and talking what's going on, and there's this lady, Sherry, that is deeply, deeply passionate about cheetahs. She spent her entire life in Africa trying to preserve the cheetah population, and because they are an endangered species to an extreme, and the reality is the greatest threat to the cheetah is actually farmers.
Really?
It's no longer natural prey. It's not the predators, rather, that are out there that are creating the problems. It's that the cheetahs are going on the farm property to get the livestock.
Yeah.
The farmers have got to protect their livestock, and so they kill the cheetah.
Wow.
And so she's done everything that she can to preserve the cheetahs. And so, it's kind of like you're working on your 401k and you're thinking, okay, Joe, I've got to have growth. So darn it, I've got to add this growth stock if I'm going to have any chance of having a retirement. And I really love this lady because what she did was think outside of the box. Her job was to protect the cheetah. That's her passion. That's her love. Your job is to make sure your 401k has enough money to be able to sustain your standard of living when you retire. What she inevitably ended up doing was getting these big dogs. I mean, when I'm talking about a dog, I'm 6 foot and I'm not small. Mm-hmm. And when the dog stands up and put his paws on my shoulder, his head is a whole head and a half above mine.
What kind of dog?
These are not. It starts with a K. You can see them at the Indianapolis Zoo.
Oh my gosh, it's like a bear.
Kangles. I think it's Kangal or something like that. You think it's almost the size of a bear, but what she's done is started giving the farmers these dogs. And the cheetahs don't play with these dogs. I mean, they're not dumb animals, right?
Right.
These dogs are not pets. They're not. But nobody is getting around the livestock. That's those dogs. That's what they're raised for.
Wow.
And so instead of trying to preserve the cheetah by doing something for the cheetah, she's preserving the cheetah by protecting the farm and the natural threat against the cheetah. Make sense?
Yes, it does.
It's that connecting the pokey dot.
It's how it works together.
It's kind of going in an order of process and then figuring out what part of the gap you can fill. And when you look at portfolios or you look at 401ks, part of what you've got to consider are things that you can change or adjust that may not be for this thing, but it may mitigate risk that's on the other side. Right?
Yeah.
So remember, if you are taking care of your own money, right? My job, I'm legally liable to take care of your money as if it were my money and we were in the same situation.
Right.
Now, by definition, that's called being a fiduciary, right?
Mm-hmm.
But there are 4 things that I focus on, and my team knows the fiduciary focus is made up of these 4. It's paying attention to risk and volatility. It's paying attention to fees and expenses, paying attention to taxes, both today and tomorrow, and making sure that you get a real return. That means something above 0 plus whatever the inflation rate is,
Right.
so that your purchasing power is not destroyed. Right?
Mm-hmm.
So if you're taking care of your own resources, I would strongly consider, if I were you, writing those 4 things down and asking yourself, how are you addressing them? How are you dealing with them? Sometimes it's direct, saying, hey, the world's changed. I need to reallocate my 401k part that was maybe too much U.S. or maybe too much in a particular area. I need to reallocate it based on changes that are happening. We live in a fluid world, right? I need to make I need to make these changes based on this data, not because it's a quarter, not because one did better than the other,
or it was good last year.
None of it's because of the condition that we live in now. I may need to make a change, and then you also need to look at it and say, okay, do I need to buy a dog? And I don't mean a bad stock in that. Is there something in my portfolio that I need to protect, or that a weakness that I have that I can use a different part of logic or a different reasoning to be able to defend? And when we do reviews for our families, like everybody else, they want to come in and they want to say, well, why do we own this stock? Or why do we own this stock? And we can always address that, and we do. But it's usually how this one relates to this one that relates to this one.
Right.
There's a bond, if you will, so that they're all working in unison and together.
So that's kind of specific. But if people have a general question about that sort of thing, they can send you an email, right? They can ask you a question.
They can obviously ask a question for the radio show anytime
Right,
they want.
exactly.
You can email me, consider this at yourlifeafterwork.com. And if you're a Twitter person, go, hashtag Ask Big Joe. And happy to be able to address it on the show. It's hard to deal with the specifics.
Yeah, you can't
We're always more than willing to share a cup of coffee. Dean Huddleston's our planner up in the Lafayette office. Aaron Room's down in the Indy office. Happy to have those conversations and see if there are things, changes that you should make or things that you should be looking at. Hey, you're listening to Consider This. Joe Clark, Sherry Canto. So happy to have you along. We'll take a break. Be back in just a flash.
Are you overwhelmed with financial complexity? Are you confused about how your 401k and your IRAs work together? If so, you're not alone. At the Financial Enhancement Group, we work to make your financial life simple. On a single sheet of paper we call the Family Focus page, we help you lay out your long-term financial objective with the next 36-month key financial objectives. At the Financial Enhancement Group, we keep it simple. We keep you on track. We work together. 800-928-4001. We look forward to hearing from you.
Good morning and welcome back to Consider This, or good afternoon if you're new to us on WILO, 4 to 5, Thursdays afternoon. Happy to have you along as well. But for the rest of you, good morning. Saturday morning on Shine 99, or on WQME rather, 9 to 10, Shine 99, 10 to 11 on Sunday mornings. Happy to have you. All right, Sherry.
Okay.
Now, what was the problem with the article?
I thought it was, so I didn't understand all the terminology. I was reading it and I just, I need some clarification. I got the gist. I understand the point, but some of the...
All right, so you're a flea flicker, or you're a football fan.
I am.
And so one of the things that I teach my students at Purdue, I ask them how many are football people, and about 2/3 will always raise their hand. How many of them understand what a flea flicker is? And about half of those people will raise their hand.
Okay.
So for those of you who don't know what a flea flicker is, it's depending on the coach. There's between 11 and 13 different moves that come out of the players in order to create this play. You've all seen it. It's when the quarterback throws the ball to a receiver. The receiver tends to throw it back to the quarterback. The quarterback throws it downfield to a receiver. Right.
Yeah.
Can be the other way around, where it's the receiver that's throwing the ball to the quarterback.
Catches everyone off guard.
Catches everybody off guard. But that's called a flea flicker.
Yep.
And when I'm talking to football people, all I have to say is the flea flicker.
Okay.
Or a different kind of play. We can say the Hail Mary, and we don't have to explain what it is. In our heads, it's already implanted.
Really?
Right?
Okay.
Well, we have the story because that's how our minds work. We keep stories.
Yes.
Right? And so we always want to make sure that we're telling ourselves the right story.
Right.
Otherwise, we have a very wrong vision of what's happening.
Right. And
Okay?
I have football stories in my head, but I guess I don't have this whole diversification thing in my head.
Well, and that's the point when we communicate, because of who I communicate with a lot of my life, every now and then I can go back and begin to use jargon or initials especially
Right.
that confuse people. I remember calling somebody who very well should have known to say the ECB is getting ready to do more QE. And, apparently it's like Peyton going Omaha, right?
Yeah.
It's the guy on the other end said, Joe, you got to stop. And this was a person who should have, based on their position, known what all of those initials stood for. So in the article, here's the thesis that I had. Mm-hmm. There are some people who only want to own the S&P 500 index. They tend to believe that and this goes right along with that theory of diversification. Most people tend to believe that the S&P 500 is an investment index that is made up of 500 companies that are equally weighted, so that you've got your money divided amongst 500 different places. So first, what I did in the article was took people back to understanding where the S&P 500 came from. And you will every now and then hear economists talk about leading or lagging economic indicators.
Right.
And every now and then you'll hear them talk about something that's coincidental, that happens at the same time. Leading indicator would mean to tell you that because of this, we can expect the economy to behave like that. Lagging would mean we thought the economy would do this. Sure enough, the market has responded, and the indicator now shows that we were right in our earlier belief. All right,
Okay.
Leading and lagging. That's all it means. And so Standard & Poor's was commissioned to design an index of 500 companies that represented multiple sectors, or if you will, pieces of the United States economy. All right? So the pieces being the industrials, the utility sector, healthcare, technology, the consumer staples,
Right.
consumer discretionary, if you will.
And that's diversified. That's right.
Those are all diversified.
Right.
But Standard & Poor's, you have to understand what happened here. Standard & Poor's created that index because they knew when the economy would, the belief was that our economy would function in a clock-like cycle where you had a peak, then a contraction at like 3 o'clock. Consider peak being at
Right.
noon. A contraction at 3, a recession at 6, an expansion at 9,
Yep.
and you would just go around this clock.
Yeah.
And the belief was that utilities would perform better than industrials if you were between the contraction and the recession, and industrials would perform better, or consumer discretionary would perform
you're-
better if you're expansion to peak.
Sure.
Right? And
Makes
so they
sense.
could use those stock prices to determine where we were in the economy as either, depending on your argument, leading or lagging economic indicator. Some people will say the market will always tell you where it's going to be,
Yes.
right? That's not always true, but that's where it comes from. Now, what happened is a guy named John Bogle was pretty much the first guy to do this. Bogle built Vanguard. And Bogle was the marketeer, if you will, that said, let's just wrap this index into a fund and we'll sell the S&P 500 to people. And he made the decision to do that based on market capitalization. And there was a lot, the companies were a lot more spread out at the time in terms of value. Okay, so it was based on market cap, and we just had the story of the five
Yeah.
horsemen, right?
Right, yeah.
So what happened inside of the S&P 500, even if you look at it today, as of the taping of this show, the top 10 companies in the S&P 500 represent more than the bottom 125 companies.
Okay.
In fact, the 10 companies control more than 20% of the value of the whole index. So when you're buying the S&P 500, to a large degree, you are diversified, but perhaps not by as much as you thought, and understand the way that market cap works. For instance, going into January of 2000, the technology and telecommunication sector made up almost 40% Think about the five horsemen.
Right.
Made up almost 40% of the value of the S&P 500.
It's amazing.
So when you look at your mom and dad, and in your case, Sherry, you and I were old enough to have money in markets then. If I would have told you that in your 401k that you had at the time, that you had 40% of your money in a sector that had negative net earnings, you would have thought I was crazy. Mm-hmm. And yet that's precisely what happened because people didn't understand the diversification.
Wow.
Right? So the beginning of the article was explaining where the S&P 500 came from. Mm-hmm. The second part of it then was explaining that in the world of exchange-traded funds, which is a newer tool, it's only been around since the mid-'80s. So, it's been around as long as I have. We were one of the first people to adopt using them in the late 90s when they became accessible for non-institutional type managers. We've been using them for over 17, 18 years now. But the exchange-traded fund kind of looks like a mutual fund, except it has no manager. So I know exactly what it is that I own inside. So there's no case of me not knowing that I own the five horsemen over and over and over and over and over again, right? It's much, much cheaper to operate. My money is held separate of yours, whereas in a mutual fund, it's held collectively, right?
Yeah.
I know exactly what it is I own, and it's cheaper. I like every bit of the sound of that,
yes.
Right? And inside of the S&P 500, you can buy the S&P 500 without buying a mutual fund with one symbol. It's called SPY. It's the most traded thing on the exchanges every day. If you turn on the CNBC or Bloomberg and you watch the ticker tape go by, you're going to see a lot of SPY. And SPY is the exchange traded fund for the S&P 500, where indeed those 10 largest companies would control more than 20% of the move, but you would own a portion of all 500 companies, right? Now, my argument in the article was, let's say that you had $500,000 in your nest egg, and $250,000 of it was in a taxable account,
yeah,
and $250,000 was in your IRA.
Okay.
Right? One's tax deferred, meaning no taxes are going to be paid until the money comes out. One of them, on the other hand, is very much subject to taxation along the way. And let's say you believe in passive investing, right?
Okay.
Passive investing means I just want to own the index. Joe, I don't believe that you and your team can outproduce the market. I don't buy into any of that. I want to own stuff the cheapest way that I possibly can, and I want to be diversified to the best of my ability. And in my belief, the S&P 500 is diversification. Now, keep in mind, I didn't believe most of what I just said. I'm saying if you believe that, what I would often see is somebody who would come in who would have an IRA with the S&P 500, and they would come in with a brokerage account that had the S&P 500.
Okay.
With the exchange-traded funds, you can actually buy those 9 slivers. Remember, there's 9 pieces to the S&P 500?
Yeah.
You can actually buy a piece of the S&P 500, not all of it. So you could buy the financials. You could buy healthcare. You could buy technology, utilities, industrials. You pick it.
You choose.
Same companies, but you're only buying that sector. Now, we've talked on this show before about how dividends work. And by the way, if you want to go back and listen to previous shows, they're on our website. You can get them at yourlifeafterwork.com or at iTunes. But we've talked about this on this program before. And then one of the things that a company can do that has profit is pay dividends. Right? And those dividends are declared by the board of directors and then distributed. If you get a dividend and you're in an IRA account, all that happened was your account got bigger.
Right.
If you get a dividend in a retail account, a taxable account, you get a 1099 and you got to pay the IRS
taxes.
money.
Yeah.
And so my point was, if you want to be diversified and your accounts are reasonably similar in size, you can do a little bit of math and adjust this out.
Sure.
Why not own the part of the S&P 500 in your IRA that produces the most dividends?
Right.
Like one sector is about 3.23% in dividend yield, right? Another sector, for instance, is 1.2. It's a 2% difference.
So it makes sense.
In $250,000 account, that's about $5,000 of dividends that are hitting your tax return every year that don't need to hit your tax return every year. Could literally save you a lot more than $1,000 in taxes just by understanding how the tax code works.
Yeah.
And by paying attention to it.
Now, I really get that now.
Good,
I mean,
I'm
I
glad.
didn't get that from reading it, but it makes me think.
So I talk better than I write.
You talk better than you write, yeah.
Thanks.
No, it makes me think, though, you're right. There's more freedom, there's more control in the ETFs, but you also, onus is on you to know what you're doing.
So, I'll keep going.
And so that we get back to the fiduciary responsibility. You either take it.
Fiduciary focus.
Well, focus. Okay.
The fiduciary focus. Remember, there's 4 things. If everybody's got a fiduciary, right? And if you're not familiar with that word, it's real simple. I am legally obligated to take care of your money as if it were my money and we were in the same situation. Mm-hmm. We don't sell things, right?
Right.
So under suitability, that's not the case. At the end of the day, you're your own fiduciary. Mm-hmm. You're making that call. But as a fiduciary, I have a focus, and that's what I teach my students. It's what I'll teach you on this show. There are 4 things that you have to always pay attention to, and they come in this order: risk and volatility, fees and expenses, taxes, not just that I pay today, but tomorrow also.
Right.
Last but not least is making sure that I get a real return. If you keep your focus evenly adjusted on those 4 things, then you will find you will make better decisions. And you just can't get comfortable because you understand it.
Right.
But the number of things that I see written that say, well, consult your tax advisor, which nobody does.
Yeah.
I get to spend 12 years of my life working in the backside of a big CPA firm. Trust me.
Nobody
does until it's too late. They report to their CPA, hey, this is what I did, now what?
Yeah.
Right?
Yeah.
It's not the tax planning portion. We talk about thermometers and thermostats, right? Thermometers report. They tell you the temperature. Thermostats have the ability to change.
I have to just say this really quick. In one of your prior shows, you brought up the idea of Hillary Clinton's book, mm-hmm. and that it wasn't processed from a tax standpoint properly, right. and cost millions of dollars. And I've told that story after we did that show. I've told that story a number of times because it hits me so hard that these are intelligent people with paying bongo bucks to someone to look out for them, and nobody made that connection.
Doesn't matter what you pay.
Yeah.
It matters when you behave.
Right.
Yeah. And so you really have to be able to pay attention to this. So go to the website. You can read the article. I think they may even put it up on the Clinton County Daily News. We're going to submit an article there for them every week, and you can tell Russ that you want to see it, and it'll be up there, I'm sure. But hey, you're listening to Consider This with Joe Clark, Sherry Contos. I got to take a break. If you need something, give us a call, 800-928-4001, or shoot me an email. Consider this at yourlifeafterwork.com. We'll take a break. Come right back.
Hello, I'm Angie Kinzer, the event coordinator for the Financial Enhancement Group. We believe that education is critical to making wise decisions. Frequently, the Financial Enhancement Group provides educational workshops on particular parts of the financial planning process. Call 1-800-928-4001 or visit our website at yourlifeafterwork.com to find upcoming opportunities to learn more about your money. Thanks for listening to Consider This, and don't forget to call 1-800-928-4001 and ask for Angie.
You've been listening to the best of Consider This with Joe Clark, Sherry Contos, and others. Hope you've had a wonderful time listening to it. If there's something that has piqued your interest, made you think a little bit more about your financial life, then I feel good about what we've done. The idea is to truly bring information forward in a usable fashion that you can both understand and apply to your financial lives. As I have spent 27 years as a certified financial planner, 7 of the last years as an adjunct professor at Purdue where I teach financial planning, I do very much consider this part of my ministry, and it's teaching people how to understand their money. C.S. Lewis said the greatest sin of all is pride. I think if we take that back, one of those common areas of pride comes out of finance and out of money. It's also one of the things that interrupts marriage in a very large way. If I can spend my hour, what I like to call the fastest hour in radio, teaching you or giving you ideas about things that you need to consider financially that can either help make the marital life a little bit better or help make us better understand our money so that we can be better stewards. Again, as I said, I feel like I've done my job. If you've got a question or comment, if you're a Twitter person, you can always find us at big_Joe_Clark. Is my Twitter handle. The way you can ask us a question on the show is #AskBigJoe. Happy to have your questions there. And of course, you can always shoot us an email, Consider This at yourlifeafterwork.com. If you would like more like this or to read our weekly newspaper column, don't forget you can always go to the website at yourlifeafterwork.com. There's quite a few past radio shows, past newspaper columns there where you can find out more information about your life after work and how we can bring it all together. We appreciate you taking the time to listen to the show. God bless. Have a great week. If there's anything we can do to be of service, please don't hesitate to let us know. Take care. We'll see you again next week.
Thanks for listening to Consider This with Big Joe Clark. Big Joe can be reached at 800-928-4001 or via email at bigjoe@yourlifeafterwork.com. The Financial Enhancement Group is located at 429 East 14th Street, Anderson, Indiana, 46016. Be sure to check out their website for more information at yourlifeafterwork.com. Have a great week, and don't forget to consider this.